Well, good morning, everyone, and welcome to Finance Friday. I'm Hard Money Jim, speaking again today from Coronado, California, where every day is Earth Day and gasoline prices are still $6 a gallon, but the sun still shines every day. So looking outside, it is indeed another beautiful day in paradise. By the way, after today, I'll be taking a break for the next couple of weeks to do some business and personal travel, but I'll be back on Friday, May 13th to chat with you once again. Now, before I get to the main event, which I'm calling Attack of the Zombies, I want to acknowledge some very good feedback I got from a couple of listeners. First of all, I received some constructive suggestions from a young person who commented that my presentation last time was a little hard to follow until I got to the end. In other words, he didn't know where I was going until I actually got there. And I thought I better correct that. So I just want to tell you, I'm going to try to add interim summaries and better transitions to these discussions so that it's easier to follow the line of thinking that I'm promoting. Okay. Now, second, another listener asked if I could start providing investment advice on this forum. I basically told him that I thought it might be only appropriate to offer very generalized opinions on investments when that seems appropriate to do so, but that I don't want to advocate for any specific portfolio or stock. And, thinking on it further, I think one of these days soon I will do a show on what investment services I subscribe to, who I read, so you can evaluate those for yourself and decide if they're, right for you. But my point is that advising you on how to invest is as personal as choosing a romantic partner or decorating your living room. I would take the responsibility of giving specific investment advice too seriously to try to offer it as a one-size-fits-all, blanket piece of advice. So hope you understand that. Now, having said that, I do today, before I get started to the main event, want to offer some very generalized advice on protecting yourself against inflation, which I think is going to be with us for a while. Now, I'll offer, this will not be a comprehensive discussion of inflation protection, but I'm going to offer you two ideas. One is what to do, and one is what not to do. So let me get to sharing my screen here. And the first idea is I'd like to call your attention to a Wall Street Journal article from the other day by Lawrence Kotlikoff, who's a veteran economist from Boston University. And he's a well-known advisor to individual investors. Kotlikoff says you should own a house. And I agree. If you can, you should own the house you live in. The reason you would not do this is if you thought the housing market's in a bubble and it's about to collapse. And that can happen, but more likely, I think a big part of the current big demand for houses and the surge in home prices, a big part of that is due to a demographic shift. And that is a shift toward more individual home ownership caused by the work from home trend. Now, that work from home trend was not caused by the COVID lockdowns. I think the lockdowns just accelerated them. So I think that trend is well in place and may have accelerated some years, over what it would have been. House prices could soften and they might even decline, but they're just as likely to climb, maybe more likely to climb. And I think in the long run, a house is a pretty good, not perfect, but a pretty good way to maintain your wealth as the value of your money declines under inflation. So take a look at that Kotlikoff article from April 18th in the Wall Street Journal if you have time. Now, I have an additional reason and a more qualitative reason, but an equally important reason for owning a home, which I don't think you will hear from anyone else. And that is this. I think your personal house is the most secure property you can own. Under an increasingly intrusive government, one that seems to gradually eat away at our property rights, owning a home, at least in the USA, is the most secure against a government taking, because home ownership is a strong, popular American tradition. It's very important to the middle class. It's very important to the American dream. And so I think it'll be the last thing that a statist government tries to take away. So my view is owning a home is your first line of defense, both against the declining purchasing power of your dollar, inflation, and it's your first line of defense against government intrusion on property rights. So if you can, I say, own the home you live in, and that's my first piece of investment advice, generalized, okay? Second piece. Now, a few weeks ago, you may recall, Jonathan Honig commented on the Super Chat, the bond market's getting killed. And of course, that's very true. And I want to highlight that comment. What you're looking at here, which looks like a big bowl of spaghetti, is a group of line graphs, each line representing the total return performance of the Bloomberg Global Aggregate Bond Index. That's for each year. Each line is a year since 1978. So this index, this Bloomberg Aggregate Bond Index, represents a weighted measure of all widely traded bonds from all around the world. It represents 25 different currencies. The majority are in US dollars, but it's worldwide. And this market valuation of this index is currently about $62 trillion. And it includes over 28,000 different bonds. And its market value is down about $5 trillion year to date. So that's why I chose it. It's a broad measure of the whole worldwide bond market. Okay, so each line on the graph is a measure of the total return for all bonds for that year. And so in bonds, just to remind you, total return is interest payments plus market value appreciation or market value decline, depending on whether interest rates rose or fell during the time that return is measured. So let's look, for example, this green line at the top, this stepping green line, that investing in that's 1999. Investing in this index that year would have returned almost 20%. Okay, this is a stair-step line because in that particular year, they only measured the bond returns once a month. Okay, next look at the worst full year's performance. That's this thin red line down at the bottom. That's 1995. In that year, this index total return was minus 5.17%. That's the worst full year loss to date. Okay? So you can see that in the typical range, the worst you ever lost before in a full year was 5%. Now, look at the thick black line on the bottom down here. This is the total return year to date of this index this year. This is what Jonathan Honig was talking about. We're less than 4 months into this year, and we have never seen a decline in value of bonds of this magnitude. Never seen it. Now, this appears, I don't know, tectonic to me. This feels like an earthquake. This feels like it's a very big, important market pricing signal that something important has changed. I have not seen this kind of, I don't see this kind of a move as just a little interesting factoid. This move should alert us, I think, to something serious is going on in bond markets worldwide. Okay, so, flashing warning. So, excuse me, that's my second piece of generalized advice today. Do not jump into the bond market. Do not own bonds. Own your own home, but don't buy bonds, okay? All right, so that leads in nicely today, I think, to the main event, which I'm calling Attack of the Zombies. And here's where we are going in today's discussion. We've talked a lot about, in the past, how the Fed influences money supply and interest rates. They create money, they direct it to specific players in the investment markets. And through years of quantitative easing, they have pumped money into asset markets like stocks and bonds and real estate, and they've brought interest rates down to their lowest levels in 4,000 years of recorded history. And I did not misstate that. That is 4,000 years of recorded history. If you look in this book, if you page through this book, A History of Interest Rates by Sidney Homer and Richard Silla, and I recommend owning this book for every investor, you will not find any period of such low interest rates anywhere in the world ever in the history of civilization as we have had in the last 12 years. And that's true of all categories of interest rates, whether you're talking about short-term money market rates, which have often been zero or near zero, or even negative in some cases in recent years, or whether you're talking about the higher risk rates like the corporate bond market and the long-term government rates. So I contend that interest rates have no reason to go near zero as they have unless they are manipulated by powerful central banks. So that is my premise on why rates have dropped so low. Not everyone agrees with that, but that is my view. So anyway, here's my overview for today. I want to demonstrate what the consequences in business and to the economy are of the Fed's manipulation of interest rates to these very low levels over a long period of time. And I want to show that easy money and low rates that were meant to stimulate the economy, excuse me, actually lead to unprofitable companies that consume scarce capital, that is the savings, people's savings, that would be better used for other purposes. And the lives of these unprofitable companies get prolonged, causing economic growth to stagnate or even decline. And these companies, I say, should not exist in a market economy. They're like the walking dead, and only by killing them off can the economy resume its normal growth potential. These zombie companies, as I'm calling them, were created or their lives were prolonged by the policies of the central bank. And now, ironically, as inflation becomes important to the central banks and they feel they have to act, it will be the actions of the central banks that kill these companies. So the Fed created the zombies, and it's the Fed that has to kill the zombies. And so that's where we're going in our discussion today. And this isn't just about, by the way, these particular companies. There's a further reason to study these companies. Understanding them, how they got there, is a kind of a practical, almost classroom on the consequences of money creation, which, as you know, I'm interested in. So a study of these companies, these zombies, gives us a pretty clear look at the kind of economic monster that fiat money can create. So they deserve our attention. Okay, zombie companies. Why are they called zombies? Because they're the walking dead of the business world. Their businesses are not really viable, but they are allowed to continue operating half alive because they borrow money so easily and so cheaply. There is actually, among financial analysts, an accepted definition of a, quote, zombie company. When research organizations, like Financial Times or Leuthal Group or so forth, define them and analyze them, they define them as companies that have not earned enough in operating profits to pay interest on their debt for at least 3 years. Haven't earned enough profit to pay interest on their debt for at least 3 years, okay? And in a normal economy where interest rates are fluctuating gradually in a natural business cycle, most of these companies would go out of business gradually. but they exist in a low and falling interest rate environment because suppressed rates are a kind of financial subsidy. Typically, these companies continue to borrow more and more money to cover their operating costs until interest rates finally have to rise, at which time they face mass extinction. And like any mass extinction, a big event like that will have sudden and severe consequences on the economy. These companies, these zombies, are operating as if, put it in your own context, as if you were ringing up an unpayable debt on your credit card. And you continue to charge more and more debt in order to pay off existing debt. So it's like a self-imposed Ponzi scheme based on hope. I mean, it works temporarily only because someone is willing to lend you more money to live beyond your means. So maybe you start financing your debts at 12%, say. But just as you reach the limit of your income, the borrowing rate drops to 9%. That cuts your required payments. So you're able to take on more debt. And then, as rates drop, rinse and repeat as long as interest rates keep dropping. Now, you can take that process to its absurd extreme. Just imagine interest rates actually do drop to zero. You would have, and in some places they have, we're not going to go into that, you would have no cost to borrow at all. You would take all the free money offered to you. Your debt could be infinite and it wouldn't matter. Now it's in the zombie markets, it's not that bad, but it's been close to that. So to understand a freak like the zombie companies, I want to first review the environment in which a normal, healthy company has to function and why in that normal environment, it's impossible for zombies to develop. It's impossible for a company to become the kind of distorted monstrosity that we see. So to explain that, we're going to look at a well-functioning market economy and then look at our current economy. Now, a normal economy is a process of continuous creative destruction, which is an idea that was explained in detail by the great Austrian economist Joseph Schumpeter. He said that capitalism can be understood as an evolutionary process of continuous innovation and creative destruction. You've probably heard that term before. Schumpeter said that the fundamental impulse that sets and keeps the capitalist engine in motion comes from new consumer goods, the new methods of production, the new markets, the new forms of industrial organization that capitalist enterprise creates. In other words, it's innovation. Businesses rise and fall, some win and lose. Profitable companies survive and prosper, while the unprofitable ones either adapt or go out of business. Basically, the theory of creative destruction assumes that longstanding business arrangements must be destroyed in order to free up resources and energy that can then be deployed for innovation. Now, to Schumpeter, economic development is created by the opportunity to seek profit. So businessmen of all types, entrepreneurs, try something new in order to make a profit. If you make a profit, that generally means the customers are getting what they want. And this is the ultimate test of the goodness or the badness of a business. It's its profitability. Labor and materials, which are the factors of production, will always gravitate toward the more profitable companies because higher profits allow labor and materials to be bought for a higher price, and labor and materials will seek their highest price. Now, some labor and materials will stay employed in the less profitable companies as long as management can pay them with the hope of continuing. And some unprofitable companies can will just hang on until they can't survive anymore, and they'll go bankrupt. And then, only then, will their labor and resources move to a more profitable business. Now, usually it's not quite like that. Usually businesses adapt but some hang on to the end until they go out of business. But anyway, the whole thing is a continuous evolutionary process driven by competition and the pursuit of profits. The continual, gradual destruction of bad businesses is, quote, creative, because the resources of these companies are deployed to new uses that are more profitable and more desired by the market, more productive in the eyes of the consumers. Destruction occurs, yes, but the general direction of the economy is improved living conditions and positive growth. It's an organic process. It's a dynamic process. It's a process of constant change, like evolution. Now, as implied by the word destruction, creative destruction is, it inevitably results in losers and winners. Producers and workers committed to the older technologies get left stranded. Producers and workers in new technologies survive and prosper until the next innovation. I think you get the idea. So what are some examples of creative destruction, just to concretize this? Historical examples include, say, Henry Ford's assembly line and how that revolutionized the automobile manufacturing industry. And now, however, that revolution also displaced older markets, and it forced out older businesses and workers, like buggy whip makers. Now, Netflix, been in the news lately, is a modern example of creative destruction because it overthrew disc rental, video disc rental, and traditional media industries. Goodbye Blockbuster, right? If you follow Netflix stock, you might have noticed that it badly missed its subscription growth targets recently, and the stock dropped like 40%. So in the case of Netflix, we may be seeing a tipping point in the creative destruction process. Maybe the video streaming services have possibly reached their peak growth, and maybe it's starting to stall a little bit. Maybe this price drop is an early warning sign. Other examples of creative destruction come, easily to mind. Uber has upended the taxi monopoly. Taxi drivers now drive Ubers. Amazon disrupted retail space. Its retail workers now often work at Amazon warehouses, and Amazon warehouses are being built instead of the department stores. Substack, where I write, may be disrupting the big tech media companies because their suppression of speech is not popular. You can name dozens of examples just by looking around at the products and services that you use every day. Now, what is the effect of, here's getting to the closer to the zombies here. What's the effect of interest rates on this process? We need to understand that in the process of creation and destruction, businessmen are competing for scarce labor and materials. These factors are limited. And under normal circumstances, the way you get access to labor and materials is through money. The more money you have, the more access to labor and materials you have for your innovative business. Money is therefore critical, and in normal circumstances, money too is a limited factor of production. And this is where interest rates, the quantity of money, and the cost of money come in. If profits are higher in a new industry, that industry can afford to borrow more money and pay more in interest rates. The profitable company outcompetes the non-profitable company for money, for capital, because no one will lend if there are no profits to repay the interest costs. The unprofitable company, on the other hand, cannot borrow, so it cannot invest and it cannot grow. It has to adapt or gradually go out of business, and this happens all the time. That's how things are supposed to work under a competitive, healthy investment environment. But that is not the financial world of the last 12 years, or maybe in some ways even before that. The last 12 years of low and declining rates have turned the Darwinian process of business evolution right on its head. It's turned the normal Darwinian process into a survival of the unfittest. Instead of creative destruction, you now have what you could call destructive creation, meaning that we have the creation and perpetuation of businesses that consume capital rather than creating value. It's the Fed's policies of suppressing these interest rates that have encouraged a new population of zombie companies, which I say many of which should not exist. Okay, now let's pause right here for questions in Super Chat and so forth. And when we come back, we'll start to meet the zombies. What have we got anything, Daniel, that I should address?
We have one comment in Super Chat from Mary Ellen. Thank you for $2. She says, creative distraction could be called progress.
It's absolutely, yes, very good observation. It absolutely is progress. It's necessary. It's no different it's no more negative than it's negative that we should all grow. Think about the creative destruction that goes on at the cellular level every day in our bodies, right? That's going on all the time. It's a necessary part of growth. That's only an analogy, but it's absolutely true in economics, and it should never be considered, by the fact that it's got that name destruction, it should never be considered a negative thing. It's a very positive thing. So thanks for that. And thanks for the donation, really. All right, well, let's meet the zombies. Here they are. These are companies that in times past would have had to fail. And in failing, they would have been a sign of success, in a sense, for the capitalist system. Because in getting out of the way, this gets to Mary Elaine's point, in getting out of the way, they would have made room for new life. But nowadays, in surviving, they crowd out the better companies and crowd out the savings and capital that might have been better employed. I chose this particular image because they are desperately reaching out to consume capital, just like these zombies are craving healthy human flesh. So let's now meet the zombie herd and see just how big this population has grown. So this is a, let's see here. I want first, I'm sorry, I get a little ahead. Let me back up. There we go. Let's hold it steady. All right, this is a graph of the number, the percentage of zombie companies in the Russell 3000. The Russell 3000 is an index of smaller capitalization stocks, and it got this level got up to about 15% back in the big tech bubble of 2000, 2002. It's approaching those levels again. It probably is at these levels. The latest data I could get was from 2021. So they're about, as I said, about 15% of the small cap companies here. It's rising. And again, these are companies whose profits are less than their interest payments for at least 3 years. Okay. I don't know about you, but to me, a 15% number that people of companies that have been alive for 3 years, not paying their interest costs, that's high to me. To me, that's high. Okay, and here we are. This is even worse in the S&P 1500. The Standard & Poor's 1500 are the 1,500 largest firms in the USA. And the number of zombies here is approaching 20%. Now let's think about how these zombie companies come into existence. What happens when interest rates are artificially depressed and continually lowered for a long time? What's happened is the Fed's flooded the investment markets with money that's looking for a yield. Too much money makes that money too cheap. Interest rates decline because the amount of cash available exceeds the available for investment, exceeds the good investments that are available. And ideas that normally would be regarded as silly or unviable actually get a second look, and they get investment dollars. And their values get bloated, and that in turn sends a false market signal to financiers. Let's look for a minute at what happened to interest rates over the last decades. This is the 10-year Treasury yield, but the charts of all rates, mortgages, high-yield bonds, and everything, looks very similar to this. And as rates decline, this means that a business that would normally have gone out of business gradually or reorganized or shrunk, it's able to hang on year after year in the hope of getting lucky, like the credit card example I gave. The normal forces of higher interest rates do not force these companies to reallocate their resources, their labor, their materials, and their ingenuity. Market discipline is severely inhibited with artificially low interest rates. So these companies keep on refinancing year after year, and they just hang on thinking someday they'll get lucky. But there are important effects on the rest of the economy when you do this. Remember that the continual borrowing of money gives these zombie companies a real claim. You know, every dollar is worth the same. It gives these companies a real claim on the factors of production, on labor and material, and it allows them to compete for labor and material that they never would have gotten to look at, to have access to in the first place. So let's look at bankruptcies. A modest number of bankruptcies is a normal part of the creative destruction process. We should be having more bankruptcies. This is an interesting chart to me. The light blue line in the middle shows average bankruptcies after the start of a recession. This is measuring a number of recessions. You can see they go up as the recession proceeds, okay? That makes sense. The red line shows bankruptcies associated with the great financial crisis of 2008 and 9, as you would expect. But now look at the great lockdown period. That's the dark blue line. Bankruptcies practically go to zero. I mean, like my cousin in Texas says, that ain't right. This is clearly, to me, a sign that the zombie population is being kept on artificial life support. The warning signals that normal bankruptcies, bankruptcy events send to the market have been silenced. Suppressing interest rates this way sends sort of an all is well signal to the market when the signs should be flashing danger, danger. And we now have kind of a pent-up demand in reverse. When these companies do become unviable, as I think they will become in the next months and years with rising rates, they may all crash at once, causing some pretty significant surprise and disruption in the economy. And we're talking here about recession or even depression. Now, this is a big problem for the Federal Reserve, which caused this problem by overstimulating the economy in its effort to set consumer price inflation at 2%. Instead, they surpassed their wildest dreams and achieved 8+% inflation. And now the only way to tamp down these price increases is to tamp down demand. And the only way to tamp down demand, at least the only tools the Fed has, is to slow down money creation and raise interest rates. And of course, who will be the first to feel the adverse effects of tighter money and higher interest rates? You guessed it, it will be the zombies. So I'm giving you a simple example here. drive this point home, this shows concretely and numerically what happens when a marginal, highly indebted company that's barely sliding along on low interest rates has to refinance at higher rates. This company has a lot of debt. It has 500 in debt, 100 in sales, 90 in operational costs, 10 is the leftover operating profit, earnings before interest and taxes, that's EBIT. Then it pays interest. On the left, you can say if it pays interest expense at 2%, its profit before tax, pardon the misspelling there, is 0. So this is a zombie. It's making no profit and it's limping along, half dead. Now look what happens on the right when interest rates go up, just 2%. It's wiped out. It's now, it has nothing, it cannot even pay its interest anymore, it's insolvent. I would say that the refinancing expense of a company like this is even worse than what I've illustrated, because if treasury rates go up 2%, higher risk loan rates will go up by much more. So the zombies won't simply have to refinance with a 2% rate increase. They'll have to do a 5 or 6% rate increase or something like that. So we do have this large cohort of zombies ready to fail when they, when rates go up. So let's think about these zombies now from the Fed's point of view. What is new today compared to the last 12 years is that now the Fed is faced with inflation. Previously, every time the stock market hiccuped, the Fed could ease more and lower rates a little bit more. But then at those times, it's happened like 4 times since 2009. But during those times, they did not have consumer price inflation to contend with, so they could get away with it. But now they have 8 or 13%, depending on who you believe, inflation, and they have said that they are going to act aggressively to crush it. So I am convinced that this time the Fed will act differently. They will not just continually flood the market with money in response to inflation. The odds are, in my view, that they're going to act aggressively enough to break something in the economy. And I think one of the first things to break will be many of these zombie companies. Now, I don't know how aggressively the Fed will have to act in order to actually dampen the demand. How much they'll have to raise rates in order to kill the zombies while not killing everything else. And so I'm going to show this slide again because I suspect that these data on this slide are an early sign that something in the economy is already breaking. I do think the Fed will not live with consumer inflation at 8% or even at 5% without acting on it. Whatever they do, they have to do enough to let creative destruction gain a foothold in the economy again. But the tragedy of the zombies is that they were allowed to develop in the first place, because now many lives and jobs and incomes have to be threatened all at once. In effect, concentrating what would have been a minor ongoing market adjustment into a chaotic and kind of sudden disaster called a recession or a depression. These zombie companies should never have gotten to this state. They're like a child, I think, that grew up only on chocolate and ice cream. The kid is alive, but he's not well, and he's destined to die an early death in an unhealthy state. The damage caused by interest rate suppression was both, therefore, cruel and wasteful. It's cruel because of the inevitable misery that will come when these companies go bankrupt, and wasteful because these companies consumed capital along the way that should have been employed more profitably. But artificially low rates falsely signaled these companies and their workers that all was well when all was not well. So I would say look forward to some interesting times as the zombie story slowly unfolds over the next few years, and it will take some years. They probably will not survive in large numbers, but if they do, we will know that the Fed has not done enough and that they've made another big mistake. Okay, so before we go to questions, wrap up here. Here's my information. It's the same as last week, but I'm going to post this video on the video of this on Substack, like I have been doing, and so feel free to address questions in writing on Substack if you want. I always appreciate those, and I will always answer. All right, I'm going to draw a line here, and Daniel, let's now wrap up with any super chat questions or comments.
So we have one more super chat from Mary Eileen. Thank you for $5. She asked, so when a government manipulates interest rates, values are diminished or lost, or values are diminished or lost? She asked.
Are you asking, I wish I could talk to you. Let me address what I think is the question. When interest rates decline, the value of existing assets rises in the market price, in the market. The discount rate is lower, and well, I've gone through over before how that happened. In other words, the relationship between asset values, especially bonds, but also stocks and interest rates, is often typically inverse. The lower the rate, the higher the value. But what drives those interest rates lower is the primary thing that drives rates artificially lower. The way that central banks manipulate those rates is by driving the asset prices higher. So a lot of people get this cause and effect wrong. They think, oh yeah, interest rates are lower and that's raised asset prices. That's not really what happened. What really happened is that more money was chasing those assets, raised their price, and therefore lowered the rate of return on those assets. Raised their price, but lowered the rate of return. And now new competing investments only have to meet that threshold. Okay? And this worked very well for the Fed when they dominate the investment markets by purchasing 30 to 40% of the bond issuance. And the Japanese central bank's done the same thing. The Chinese central bank does similar things. The European central bank does it even worse. You manipulate interest rates down by purchasing assets with printed money. That's the way the mechanism works. Okay. It makes money too cheap. It makes it impossible to tell the difference between a good investment and a bad investment. If everybody can get money at 2%, but the good businesses would have had to pay 5%, and now the good and bad businesses only pay 2%, you can't tell the difference between the good and the bad businesses. That's what's happening with the zombie companies. I hope that made sense. And by the way, thank you for the strong support, Mary Elaine.
That's all the questions.
All righty. As I said, I will not be able to be here next couple of weeks, but I'll see you again on May 13th. So till then, sayonara and be careful out there.